In this video, we are sticking with the perpetual inventory system, and we'll be looking at revenue recognition, sales returns and allowances, freight costs, and discounts. Let's look at an example. This is example 5-3. Before we get into the example, I'd like to take a few minutes to talk about revenue recognition. We have some notes in this spreadsheet here, a whole bunch of them, and near the end of the notes section, you'll see a subtitle called Revenue Recognition. I'd like to point out that under the earnings approach, revenue from any sale of goods is recognized, and that means we're going to record it via a journal entry into the accounting system. That's the best way to think of the word recognized at this beginning stage of learning accounting. So revenue will be recognized when the following four things or criteria are met. All four need to be met. The first, the performance obligation is complete. The second, the goods have been delivered. That's the most relevant to us in the examples that we're doing in Module 5 because we're looking at the buying and selling of physical goods, inventory. Third, the revenue amount to be recognized is known. That means there is little to no uncertainty about the selling price of the goods. Certainly in all of our examples and the examples that you'll encounter in most introductory accounting courses, that will be the case. The revenue or the selling price to be recognized will be a fixed amount and it will be known. There'll be no uncertainty about it. 4, the seller is confident that they will receive the amount from the purchaser. That is a fair assumption to have in all of our questions going forward and for most introductory accounting courses. So give that a read over, consider that. Revenue recognition is a very important topic in accounting. We'll look at it more later on in a later module. And for those that go on to more intermediate and advanced accounting courses, revenue recognition comes up again. To be honest, I even had interviews well after I designated as an accountant where I was asked about revenue recognition. So it's a pretty fundamental concept that comes up over and over again in accounting. Now is a good time for us to get going on example 5-3 and a good time for you to pause the video, download the spreadsheet, and to try out the questions on the required. If you've had a chance to do that already, let's get right to it and walk through the solution together. So on July 3rd, Call Me Again Phone sells 2 phones to Anchor Farm on credit terms for a total of $1,000. Credit terms are $210 net 30. The phones had a cost of $296 each. We'll see in a perpetual system that we have to do 2 entries whenever there's a sales transaction. The first will be just to recognize the sale, the credit sale, so we debit accounts receivable and credit sales revenue. Next, we have to recognize the expense on the income statement. So at $296 a unit times 2 units sold, cost of goods sold will be $592. That is an expense account that goes on the income statement. We also have to derecognize or remove this inventory from inventory. So we have to take these phones out of inventory and off the balance sheet. We do that with a credit to inventory for $592. Again, T accounts are not required, but I certainly like to use them for instructional purposes. Updating our accounts, we can see accounts receivable now sits at $1,000. Inventory from our last example, 5-2, ended at $9,785. After this transaction, it is down to $9,193. Cost of goods sold is now at $592, and we have sales revenue of $1,000. Moving on to July 7th, Anchor Farm pays for their July 3rd purchase in full. We should be debiting cash and crediting accounts receivable. The accounts receivable is settled in its entirety, $1,000. We also have to recognize that this was paid and received within the discount period. So sales discounts is part of this transaction. And we'll calculate it by taking the amount, $1,000, multiplying it by the discount percentage, which was 2%, That's $20. So the cash received is $980. So just be aware that $980 was received, and that settles the customer's receivable of $1,000, and that is because the customer took advantage of paying within the discount period. Again, let's update some of the accounts. Accounts receivable now goes down to 0. Sales discounts is now sitting at $20 after this transaction. Moving on to July 10th, Call Me Again Phones sells 5 phones to Shelly Wines on credit for $2,500. Credit terms are $210 net $30. The phones had a cost of $296 each and were sold for $500 each. So we recognize the sale, and it's a credit sale, so debit accounts receivable for $2,500, and we credit sales revenue for $2,500. We should also recognize the expense on the income statement. Cost of goods sold, $296 a unit multiplied by 5 units sold is $1,480, and we remove those products or those phones from inventory for the same amount. Credit inventory, $1,480. Updating the accounts will show that accounts receivable is now at $2,500. The cost of goods sold has increased to $2,072. Inventory has gone down as a result of the sale of goods, and inventory sits at $7,713, and sales revenue is now totaling $3,500. On July 12th, Shelly Wines provided evidence that one of the phones was slightly damaged, but still usable. Instead of returning the phone, Shelly Wines agreed to accept a $50 allowance. So here, we recognize a contra revenue account. We debit sales returns and allowances of $50, and we reduce accounts receivable by $50, credit accounts receivable $50, because we no longer can say that that $50 is receivable. We are telling the customer they don't need to pay $50. This will impact the account slightly. Accounts receivable will go down by $50 to $2,450, and sales returns and allowances is up to $50. On July 14th, Shelly Wines had one employee leave their company and didn't use or need one of the phones. Shelly Wines returns one of the phones as a result. The phone is in perfect condition and is placed back into inventory for future resale. This indicates to us that the phone that is being returned is not the same phone that had an allowance granted on it. It's a different phone. It's going to get put right back into inventory. We'll need 2 transactions to deal with this because it's a perpetual system. The first is just recognizing the return and the reduction to accounts receivable. Debit sales returns and allowances for the selling price, $500, and we credit accounts receivable for $500 because that amount is no longer receivable. We have told the customer that they can return the phone and they do not have to pay that $500 that was originally agreed upon. The second part of the transaction that we must record is since that phone is being put back into inventory, we should debit inventory to recognize the phone being put back into inventory at $296. Also, since that phone is no longer sold, we should record a credit to the cost of goods sold because earlier we had recorded it as being sold. Now that it is being returned, we should reduce the cost of goods sold by the same amount, $296. Updating the accounts, we'll see accounts receivable has decreased by $500 because that amount is no longer receivable, and now the receivable sits at $1,950. Sales returns and allowances in the bottom right-hand corner of your screen. That has gone up to $550. Inventory near the middle of the screen has also gone up as a result of putting one more phone back into inventory. and inventory sits at $8,009. Finally, the cost of goods sold has gone down because one item that was previously sold is no longer sold. So cost of goods sold now sits at $1,776. Let's take a look at July 17th, where Shelley Wines pays the outstanding balance from their July 10th purchase in full. We will debit cash and credit accounts receivable. The entire amount, $1,950, which we saw earlier. If I go up, accounts receivable was sitting at $1,950. Accounts receivable is settled in full because that entire amount related to this one customer, Shelley Wines. And Shelley Wines paid within the discount period. So we take $1,950, multiply it by the discount percentage, and we get $39. The cash received is $1,911. Updating the accounts receivable is at 0. Sales discounts has gone up to $59. And those were the only accounts impacted other than cash, which we aren't keeping up to date in these T accounts, but would be kept up to date in the actual accounting system. Requirement 2 is to prepare an income statement, a partial one in good form. Whenever you are asked to do that, ensure that you begin with the legal name of the business, the name of the statement, and if it's an income statement, statement of owner's equity, or a cash flow statement, you need to show the period of time the statement is for. We were asked to show a statement for the month ended July 31st. We were not given a year, so I've just written 20XY to represent some year. There are other periods of time that we find in accounting. It could have been for the quarter ended or the year ended. It could be even more frequent than that, but month, quarter, and annually, so for the year ended, are the most common periods you'll see. Let's take a look at the rest of the partial income statement. We start off with sales revenue of $3,500, and from that we subtract sales discounts of $59 and sales returns and allowances of $550. You can see that these two accounts, even though they sit with and close to sales revenue, they are in direct contradiction. So these are contra revenue accounts. They total $609. And if we subtract that $609 from the sales revenue of $3,500, we get net sales revenue of $2,891. Subtract the cost of goods sold of $1,776, and we get gross profit of $1,115. In our next video, we'll be looking at closing entries for a perpetual system of inventory. So see you then, and thanks for watching.